Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Thursday, February 27th, 5:46 p.m. Eastern Time. Coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Market state, we're in a mild correction, meaning we're more than 4% off the highs in the S&P 500. Obviously, if you've been following us, you know that growth stocks are much, much worse relative to where they were a few weeks ago. Check the trend gauge over here. This got worse too today. Market leaders still in red. Short term went on red on 221. Medium term today with the clear break of the 50-day moving average and the 100-day moving average. Uh, Medium term now to red, and that really applied to the S&P 500 and Nasdaq 100, which were bumping their heads on the top of that level and using the 100-day as support. But today broke the 100-day. Next support level down for the S&P and the Nasdaq is the 150-day or 30-week moving average. As far as the long-term outlook goes, still the green arrow as the S&P and Nasdaq, also the Dow, are above this level, and the equal weight S&P. However, mid caps join small caps below the 200-day moving average today, which is why we've got the yellow sub arrow on long term. Market never gets into serious trouble until the S&P 500 breaks the 200-day moving average. That's when you're at risk for a bear market. All bear markets occur below the 200-day moving average. We're less than 2% above that level now. Actually, I think we're closer to 4% above that level. But and 4% off the high. So um, we'll talk about some sentiment as we get through the video, some very interesting readings coming up, and we will update them when we get to the trend gauge. So what happened today? Nvda earnings pretty good after hours on Wednesday, and in fact, Nvda messed around, flatline, never making too much of a move before or after the market. Ended up gapping up today at the open, but immediately turned tail along with the rest of the market and gave up the gains. We made the highs within the first 10 minutes on the S&P. Couple of weak attempted bounces and a late afternoon sell-off brought us to new correction lows for the S&P 500. Here are the numbers. 2121 continues to be under construction. This morning I went through a list of either good companies with good businesses or leaders that have held up against the 21. There are about 40 names in there. Some that were above the 21. Some of them broke that level by the close. We'll go through those 40 names just to give you an idea of what we're keeping an eye on. Some have leadership potential. Some are just noteworthy for a reference from a sector standpoint. Big eight, all eight of them lower, down an average of 3.1%. RG8s, our eight growth ETF composite, like all lower, down an average of 2.4%. S&P gapped up 0.45%. 2% reversal from high to low on this, ended up down 1.6%, equal weight down a little less than a percent. NASDAQ 100 took it on the chin, down 2.78%. We'll look at the rest of the indexes when we get to the charts. 60/40 global stock bond portfolio down about a percent. Our flagship GROTECTION portfolio, after selling all of our tickers last Friday and lightening our index exposure. I'll show what the guidelines that we keep for that are. Down 0.72%. In fact, let's take a look at that right now. This is kind of the ceiling and floor that we use depending on where the S&P 500 is relative to its moving averages. Today, you can see breaking below the 100-day moving average. We are about a 0.5 going into today as we're between the 150 and the 100. Breaking the 100, next level down is the 150-day moving average. We got a floor of a 0.3 there, ceiling of 0.4. This is basically where we are at with 0.4. So here's the area. This is the target S&P. This is S&P exposure. Leader exposure is dictated by what they're doing. So if you have a zero point 0.4 beta and it's all the S&P 500, that's potentially significantly different than a zero point 0.4 beta if you're trying to park money in leading stocks and hope that they hold up, which is a losing proposition in a market where growth leaders are being sold. And that started last Wednesday and hasn't stopped, actually. All right, let's get to the charts. We'll start with the S&P 500 here. You can see bumping its head above on the 50-day moving average yesterday, almost today. In fact, it did overnight, hit the 6,001 level, but closing near the lows of the range. The next level down is the 150-day moving average. We're about 0.8% above there, 2.5% above the 200-day moving average. Not a whole lot to say about it. Here's that 60-minute chart that we had been talking about initially. This was the bottom level of support that was holding. That broke earlier this week. This was the initial gap at 5,900. We broke below there as well. So now this was the initial break that kicked off this latest move up, but below that level right now and into the 5850-ish support level. Back to the daily on the S&P. Let's show the equal top weighted. This had been holding up and look from the relative strength standpoint, since this sell-off started, this is about a week and a half of strong outperformance on a relative basis, although it's lower, but it broke the declining 50-day moving average today after the declining 21 acted as resistance right above its 150-day moving average and relative to the 200-day moving average, 2% away from that. Next up is the NASDAQ 100. Broke the 100-day, still above the 50-day, and this 500 level, which is the bottom of this flat base. We closed right above there, 1.8% above the 200-day moving average. Dow Jones Industrial Average showing some relative strength because it is a value driven index, but breaking the 50-day and the 100-day, significantly still above the 150-day. This is actually, it's not the leading index. RSP is the leading index year to date. This is a close second, still 3.4% above the 200-day moving average. On to mid caps, which broke the 200 today, and that 3,100 level. Continued massive relative weakness going back to this day that it made new highs back in November. Didn't make new highs in January or February the way the mid cap or the big cap indexes did. Now joining the Russell below the 200-day moving average, and here is the Russell making lower lows. Slope of the 200-day moving average still pointing up. All the other lines, moving averages on here. This is a 150-day that I have here on purple. Green is 21E. Red is 50 simple, and those are all pointing lower, and it does not point to a good picture. All right, VIX. Not even one standard deviation above the long-term average. That's up around the 29 level. So long way up today by 10.6%, just above the 20 level. This can go a lot higher if panic truly sets in. And this hasn't really been a panic. It feels like it at times, and it certainly was in some growth names as hedge funds piled out of them. But VIX, it is what it is. Above 20, we want to see it below 16. Next up is the dollar, and it popped today into the declining 21-day moving average. Strong dollar will not be good for gold and precious metals if precious metals and stocks if this continues to go higher. But we've been pulling back with a weak dollar over the last 2 weeks as well. Speaking of which, let's go to gold. Broke below, closed slightly below the 21-day moving average today. Gold stocks pounded down 3.4%. This is why we take We sold Nugget much higher twice. This is why we take offensive, do some offensive selling. Excuse me, when things get extended. Bitcoin not doing well either, broke below the lows of the flat base and that 50 level. Relative strength has been terrible over the last 3 weeks for that as well. On to bonds, broad bond index, not much volatility today, down slightly. TLT also down, yields slightly higher. There's TYX, the 30-year, PNX, the 10-year. All right. Those are the charts of our inter-asset correlation. Let's go to the tail of the tape. Excuse me. So as we mentioned, mild correction. Nvda, some news. Nvda gapped up at the open, sold immediately, ended up down, let's see, 8.5% on the day. Job openings data was weak before the open. Tomorrow we've got PCE inflation data before the open. That's the Fed pays a lot of attention there. The keys coming in, S&P against the 50 and 100 day, below both of them. NASDAQ 100 against the 50 day and the 100 day, also below both. Russell 2000 against its 200 day moving average. Terrible. Day count, 5 days down, 5 days below the 8 day moving average, 5 days below the 21 day moving average. Let's go back up here to sentiment. Fear and greed is now in the extreme fear level. We changed the highlighting to this in red, looking for a signal for some strength in the market. Stretched very much to the downside means be on the lookout. And this is supported by the amazing bull bear at AAII. Bulls up 20 or bears up 20 points to 60. AAII bulls down to 19%, down 10 percentage points. This is a strong contrarian buy signal, but it hasn't kicked in yet. And that's why we keep these secondary indicators in their proper perspective. NAAIM investment managers still very invested, up at 88, just a drop of 4 versus last week. Let's see, sectors today. To the upside, some value sectors, energy, financials, staples, and real estate. To the downside, tech. Semiconductors, software, XLK and XLU as utilities, retail also weak. As I mentioned, all of our individual stocks were sold on Friday, 221. We added slightly to RSP today and sold UPRO. This was the leveraged version of the S&P 500 to 3 times as it broke below the 100-day moving average. So our adjusted beta is 0.41. The only things we have left are SPLG and RSP. Those are one time. SPLG, obviously, our preferred ticker for the S&P 500 market cap weighted. RSP equal cap, market cap weighted. And we still have about a 2.7 size position in GLD. So our adjusted beta 0.41. Our estimated balance at risk 1.68% to the downside, and that basically reflects the S&P breaking below the 200-day moving average. Bottom line on the day, Nvda earnings can't save tech. Correction hits new lows. Not a whole lot of good news to report. In fact, basically none. Friday's keys, S&P 500 against the 100-day and 150-day envelope. NASDAQ, same thing, 100-day and 150-day. Russell 2000, we continue to watch that against the overhead 200-day moving average. Some updated levels here. On the key levels down here, we added the 150-day for a reference point. All right, I talked about stocks. Let's see. Let me bring up this list. This isn't really a leaders list as much as it is a watch list. And we're going to sort them on price relative to their 21-day moving average. And we want to start with the best first. WGS. This is a biotech, gapped up on earnings, broke below the earnings gap low. Pretty much all earnings gaps are doing this, but it hasn't even touched the 21 on the pullback, so it's got some strength. It is a biotech with sales, and it was profitable in this last earnings report. Alibaba, China continues to be to outperform the US. Baba, a leader there. Unity Software, uh, still holding above the body or the low of its earnings day gap. They'll break out from this base, but consolidating above the 21. New one, Computer Tech Services, Innodata, gapped up on its earnings report, reversed, but is still above the 21. Nutanix on earnings today gapped up, sold off immediately, but still it's a tough base breakout for Nutanix, but this is not the environment to be putting money into earnings gaps. Bros continues to act well above the 21-day moving average. AbbVie, this is one, not likely that we're going to buy this, but it did break out of a cup and handle and continues to show extreme relative strength. It's a pharma drug, solid earnings growth, sales growth, not so much, single digit. So they're growing their earnings without the sales growth, and that's really the reason why we're not in it. This is a spot where money is flowing into a defensive name. Lilly, this is one that we would consider and probably would own if the market was better. Great earnings, still's got the strong sales and earnings growth um, above the gap up day or the earnings high volume close day and above that 900 level. So certainly keeping an eye on this one if the market rights itself, but we got a long way to go there. Berkshire Hathaway, again, defensive, broke out of this base on base formation, sticking above the pivot. 2% sales growth on that, not exciting. AXSM, another biotech, profitable in 2026, holding above its recent earnings. And this was a news driven about a week before that, but holding up above the 21. T-Mobile, uh, probably the most growthy of the telecom names, like AT&T and Verizon, for example, still above the 21 and above its cup breakout. Not something we'd likely get into. Tapestry holding above the earnings gap. Not too exciting though. Intercontinental Exchange, strong relative strength above its flat base breakout. RPRX, another biotech, continuing to act well. Aerospace Defense, RTX, the old Raytheon, showing relative strength this week. We're talking Trump talking about cutting defense spending, but Raytheon not participating in the overall pullback in aerospace. Futu pulling back right to the 21-day moving average. Take Two holding up after its earnings gap. Howmet also holding up after its earnings report with a shakeout. Starbucks, this is just money and investors having confidence in the new CEO. Great move since it's, well, not great, but consistent move and trending higher from a relative standpoint after its last earnings report. MNDY, now we're getting into the ones that are weak, but holding the 21. Weak since its earnings report, but again, it did bounce at the 21 2 days ago. Penumbra pulling back since its earnings gap, but still above the 21. CME basically going sideways since its earnings gap, right away on the pivot. Seagate, uh, really ugly pullback here after its earnings report, but showing some recent relative strength over the last 4 weeks. A bunch of stocks today in the AI data center. And again, I apologize for my cold. A bunch of stocks in the AI data center all gapped up along with Nvda at the open, and then they pretty much without fail all turned tail and mostly closed lower. Seagate basically flat. CRS, steel, metals, nice move up. This was on tariffs about 2 weeks ago, pulling back since then, but holding the 21. Expedia, basically right on the 21 after its earnings gap. Vertex, flagging nicely on low volume. Confluent, now we're getting into some more tech names, and again, pulled back, undercut the 21, regained the 21 yesterday, and closed above it today. MDGL, another biotech, tried to break out of this flat base on its earnings report, pulled back today, still above the 21. Doximity, this is one growth name that we have been keeping a close eye on, but this is the market simply holding this one back. Closed just below the 21 today. Uber below the 21 since its earnings report. SE closed right on the 21. That has earnings next week. DoorDash right on the 21. Costco breaking the 21 today. IBM breaking the 21 today. GE sitting right on the 21. AEM Gold Stock closing below the 21 after Gold Stocks had a nice run. ASTS breaking the 21 today. LRN Stride closing right on the 21. Another one that had an earnings gap higher. Two of them in a row, actually. Spotify weak along with the market right below the 21. And finally, Snow gapped up on earnings today. Put in a high immediately. Sold off below the 21, sitting on its 50-day moving average. And that'll wrap it for now. Here is the S&P 500, our flagship portfolio reminder. It's named GROTECTION, designed to grow assets during uptrends, protect them, get defensive when things start to go sideways. Keep an eye on leaders, keep an eye on the indexes relative to their moving averages. Here's the ugliness. We break below this black line. This is where all bear markets occur. Right now, we're only 4%, between 4 and 5% off the highs in the S&P 500. Got another 2.5% to go to the 200-day moving average. Will we bounce? Don't know. We're very oversold for one thing. But if we do break the 21, this is where the bad news happens. Or the 200-day. That's where the bad news happens. That's the black line on this chart. Now's the time to bring your assets to Revere if you have them with an advisor that has no plan to protect the downside. We've had a lot of people reach out to us this year, and that's the push. You want your assets protected. A pie chart advisor won't do it. An index, a direct indexing advisor won't do it. We recently got 3 portfolios with 250 stocks in them, trying to be clever with direct indexing, but they're supposedly tax efficient. But if everything's going down, that's not where you want to be. It's not protecting capital. And if you're interested in becoming a client, email me or my partner, Dan or Don at revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. And that'll wrap it for Thursday, February 27th. This is Don Vandenbord with Revere Asset Management, telling it like it is. That's Reveritas, Revere with market truths. Thanks for listening and have a great day.